Hello, everyone. Welcome back to Your Finance TV to wrap up the end of the financial week for you. And as always, we have Jay Pelosky with us. How are you, Jay?
Good, Scott. Good to see you, buddy. How are you?
I'm great, thank you. I'm great, thank you. Now, the title of your musings this week is The Action is Elsewhere. Now, I'm sure you're not talking about gambling or anything like that. You're talking about the markets to us. So, what do you mean with this title, The Action is Elsewhere?
Well, Scott, we've really been focused pretty intently on the U.S. for the last couple of months, given all the action, both particularly in risk assets with equities, but also in the economy, right? We wrote our outlook last October, surprise, surprise, and talked a lot and laid out at that time the four macro surprises as our signposts, lower inflation, higher productivity, return to stability, and realization that we're early cycle, not late. And all that's, kind of gone to plan, right? All those surprises are manifesting, and the return to stability one is the one that's really starting to kick in. And it struck me as I was thinking about what to write about that, hey, we have a Fed meeting next week, but no one's really paying attention. Why? Because things are kind of done in the US. We know what's happening. The data has been very supportive. Markets have been fine. So it's really not where the action is. We think the action is shifting, and that return to stability actually allows for the rest of the world to maybe have a little bit of catch-up trade, a little bit of mean reversion, a little bit of rotation. And so we want to try and start to get people focused on that. And we recall in our outlook, we had not only the 4 for 24 macro surprises, we had the 4 for 24 market surprises, one of which is, the rest of the world is going to do well, backstop by a weaker dollar, which we expect to see manifest as we go through the course of the year. So we want to kind of get back to those things. And that was really the incentive to make that title and then write the piece as we have.
Well, you do focus on, like, as you said, we've moved like so much focus on the US, but you do have the tripolar world framework. Now, we haven't spoken about them for a while, but let's have a look at Europe because there's obviously news coming out of Europe all the time.
Right. Yeah, and that's exactly right. For folks who haven't been regular viewers, right, TPW stands for Tripolar World. Tripolar World is our macro framework we've been developing for over a decade now, really since the great financial crisis, which argues that regional integration in the three main regions of Asia, Europe, and the Americas is the operating system we're moving into. And everything that we've seen from COVID to nearshoring to CHIPS Act, Infrastructure Act, all of this is manifesting in this idea of regional integration. And so, yeah, let's we've covered the Americas and the U.S. at length. Let's touch on Europe because Europe does have some things going on, as you said, but actually it's been kind of a quiescent environment there. Markets have done well, but the economy is weaker than the U.S. certainly. And so what we're looking for there is for the ECB, which just had its meeting yesterday, no real change. And again, another example of how the big central banks are meeting, but it's not driving markets anymore. And that's been one of our key themes, right? We're shifting from monetary to fiscal policy, CHIPS Act, Infrastructure Act in the US, driving the GDP growth that we're seeing. Europe, next gen, Fit for 55, manifesting more slowly because Europe is 26 countries and therefore it takes more time to move all the pieces together. But we do expect this year to have the ECB starting to cut rates, and people are coalescing around the summertime for that to begin. And then the industrial production side, which has been really the challenge for Europe ever since Russia's invasion of the Ukraine, we expect that to start picking up as well. And that should support, a decent outlook and environment for European risk assets as we go through 2024. So Europe remains an area of focus for us. We have exposure there across the financials, small caps, And then our emerging market focus, there we have a position in Poland, which we expect to be much like Mexico, a winner from the European integration process, much as Mexico is a big winner for the integration process here in the Americas.
Okay, well, let's move to Asia. There's obviously a lot of news obviously coming out of there as well. And I want to look at Japan first, which in your musings this week. And you actually point out in there, which I'm sure a lot of people haven't noticed this week, is Japanese banks are up 4% this week, which is sort of like, if that happened in the US, like everyone's talking about it. But no one's really talking about it. So show us some highlights in Japan.
Yeah, no, I think Japan is very interesting. Asia is where we really expect the action this year, not only in Japan, but also in China. And we'll touch on that for sure. I'll talk about China a little bit at length here, hopefully in a few minutes. But Asia is where we really think the action is going to be in 2024 and probably 2025 as well, right? So in Japan, the big action is the success that Japan has had in moving away from deflation, right? And so after decades of deflation, we expect inflation has returned to Japan and is running at about 2 to 3% year over year. And yet Japan, in the Bank of Japan, has held what is called a negative interest rate policy. So their target rate, kind of like the Fed funds rate in Japan, is minus 10 basis points. Okay, so that's the negative interest rate policy, NIRP. Japan, the Bank of Japan also has yield curve control, YCC, which means that the Bank of Japan is controlling where interest rates go. So the 10-year JGB, even with inflation at 3%, the 10-year JGB yields 70 basis points. So interest rates are deeply negative. The opposite of the US, right? Where today, because inflation has fallen faster than the Fed expected, we have 3% or so inflation and a 5% plus Fed funds rate. So real rates in the US are 2 to 3%. In Japan, it's the exact opposite. Real rates are minus 2 to 3%, which is typically a very good environment for stocks, right? As opposed to bonds. You don't want to own a bond that yields 70 basis points when inflation is 3%, because in real terms, you're losing money every year. So we expect the shift in policy from the negative interest rate policy to flat, and the market is now pricing. And just in the last week, you touched on the banks. Banks are seen as big winners, obviously. It's very hard for a bank to make money when they can't charge anything for their loans. There's no spread. So banks are moving and have moved, frankly, in anticipation of the shift from minus 10 bips to flat, which the market is now pricing in to occur in April, right? So that will be the first thing, the end of the negative interest rate policy, and then the yield curve control ending thereafter. And one of my good friends, a guy who I worked with back in the day at Morgan Stanley, was actually our chief FX strategist, the guy, Stephen Jen, has said a couple of things that I think are worth pointing out. One is that the best time for Japan to move off the NIRP and the yield curve control is when inflation in Japan is falling, which it is, and when the US is cutting rates, which rates have fallen. The Fed has not yet cut, but anticipate that to happen in the coming months, as we wrote about last week. And so the time is set up for this to roll out, this policy shift to happen. And then the other interesting point is that he expects the yen, which is deeply undervalued, could rally something close to 20% from around 148 yen to the dollar today to 130 or below. So there's an opportunity in Japan to wrap up where we think you can get significant currency appreciation and stock market appreciation from that shift in policy, and from investors to really recognize that you don't want to be in bonds when that yield curve control gets taken away, right? Because obviously rates are going to go higher. So if the 10-year is now at 70 basis points, people are expecting it to go to 1% or 1.25%, which would mean obviously, you'd be losing money on your JGB positions. So we would expect there to be a significant domestic investor reallocation out of bonds into stocks. And there's also a lot going on in terms of the Tokyo Stock Exchange driving reforms that JP Morgan thinks could lead to 20% upside on equities just from the reforms alone. So there's multiple strands to the opportunity set in Japan. We've been overweight for the last year plus in our global multi-asset model. We continue to maintain that overweight. We actually shifted into a position into Japanese small caps last month in our model portfolio update, taking on a little bit more risk, right? Because we see this process unfolding. We've done really well being in the big caps. Another thing people, and here we'll wrap up here, people don't really tend to realize unless they're paying attention, is that in local currency terms, Japan outperformed the S&P last year, right? So everyone is rocking and rolling about a S&P up 20% or so. Japan outperformed the S&P in local currency terms last year. So we're in a bull market in Japan, and yet foreign investors and domestic investors really haven't participated in a big way. We think that's one of the things that could happen over the course of 2024.
Okay, well, that all sounds fantastic, but let's have a look at China, because the news hasn't been that good out of there. I actually saw an article this week, and I can't remember if it was Bloomberg. It might have been Bloomberg, because that's where most of my alerts come across, talking about how the China versus US battle is over and US has won as far as like the finance market. I'm like, if that is not the bottom of a market call, I've never heard of one.
Yeah. Well, there's a lot to say that China is bottoming. Let's hope, right? Because China has been, as I write in the musings, the proverbial pebble in the shoe, right? Because we've been positioned for a lot of what's unfolded, and the model portfolio, the GMA has done, quite well over the last 12 plus months, capturing a lot of the upside that we've seen in risk assets. But China has been the one place that we've gotten wrong, right? We were quite bullish. In fact, we did a bull bear session with Jeff Hughes in the fall, where Jeff was negative and I was quite positive, and that has not worked out well for us, right? We've been wrong. China has underperformed significantly, and we've resized our position, right? We took that on board, recognized the fact that we were wrong, which, really important as investors, if you want to stay in the game, to recognize when you're wrong, right? And, you can pat yourself on the back when you're right, but when you're wrong, you got to say, okay, wrong, and what do I do now? And one of the things we did in China is we resized, i.e. shrunk our exposure to reflect the fact that, hey, it isn't working the way we thought it was going to. Now, we still have exposure, and we've maintained some exposure in Chinese equity and in fixed income, which has done better. But now we're looking at a series of things coming together that we think could mark an important bottom. So, again, the action is elsewhere. So what are we talking about? Well, we're talking about government policy getting quite aggressive, talking about a potential $280 billion support package for the stock market, for financial markets. That, by the way, according to Morgan Stanley, is equal to 8% of the free float of Chinese equity. So a pretty big number, right? You have the Premier League coming out calling for forceful action to support the stock market, right? You have recognition that there's a significant lack of confidence in China. So if you look at Chinese consumer confidence measures, it hasn't picked up at all since the end of zero COVID a year ago. Very different from the US and Europe. We did see in the US quite a long lag between the economy doing better, stocks doing better, before consumer confidence started to pick up, right? I mean, it's just been in the last couple of months that consumer confidence in the US has picked up. China, no sign of it. And that's in part because not only have stocks not done well, But housing has been under pressure, right? The big epicenter of concerns in China is the housing and property market. So it's actually the opposite of where the U.S. is, and in this case, supports that that argument that you touched on a minute ago. Because in the U.S., we're experiencing record household net worth, right? Record high stocks, rising home prices. In China, it's the exact opposite. Stocks are down 35% from the start of 2021, and housing prices have been under pressure because there's a property bust going on. And so this is leading to the government authorities recognizing there could be some political risk here, right? Some protests as we go into the Chinese New Year in the next couple of weeks. And so our thinking is that all this is happening so that when folks go on vacation, they're feeling better about things, right? Rather than being really angry and upset about everything going down in value. So we wrote a couple of weeks ago that the property market seems to be bottoming. We highlighted the fact that Bloomberg's China junk bond index bottomed months ago and has been up 5 months in a row. So that suggests the epicenter of the crisis has stabilized. Now we see the government starting to make some pretty aggressive moves. Now, we don't expect a super big fiscal action, right? Like China took after the great financial crisis. We do not expect that, in part because the economy is growing at 5%. So, you could argue from one side that, things are actually kind of okay. The other side, the consumer confidence side, needs some shoring up. The opportunity to do that is in the financial markets. And so when you think about it, really to sum up here, we think about it as a lot like the US looked back in November, right? Sentiment was horrible. Well, sentiment is absolutely horrible in China. And the example that's going around is a China-focused hedge fund guy decided to close his doors, wrote a letter to his shareholders, and the letter got circulated, and it's all woe is me, and I've lost my touch, and the kind of stuff that suggests, okay, not going to get much worse. So sentiment, horrible. Positioning, people were absolutely massively underweight, been record selling in 2023 of Chinese equities. So positioning is very favorable. Technicals are favorable. The Shanghai CSI 300 is back to the levels that held in 2015, 2016, the last big drawdown in Chinese equity. So that suggests strong support. And you have valuation, which is not really a timing mechanism, but China is selling at 9 times forward earnings. 9 times. And when you look at the relative performance of the US equity versus China equity over the last couple of years, I mentioned from the start of 2021, Chinese equities down about 35%. US equities are up about 20% over that time period. So there's a big, opportunity for mean reversion and rotation. And so I think all this put together suggests that you can have a pretty decent move. And I took a quick look before we got on the call at KWEB, which is one of the ways we're expressing our position in China, the China Tech ETF. It's up 8% over the last couple weeks. So that's the bounce, right? That's the action starting, but still down almost 20% from its 3-month high. 3-month high, not 3-year high. 3-month high. So 3 months ago, KWEB was 20% higher than it is today. So there is a lot of room, much as in the US, right? We saw like big moves in things, 15, 20% moves in the space of a month. Could easily happen in China and still barely be at 3-month ago levels, let alone 2-year ago levels. So that's where, to sum up, so that's where we think the action could be moving, right? The action, we had it in the US. US is the leader in terms of policy, more aggressive fiscal policy than anywhere else in the world. Growth better, economy better, earnings fine. Fed is now a yawn. No big deal on the Fed. Europe kind of quiescent. Action in Asia. Bank of Japan making a multi-decade change in policy. China shoring up consumer confidence, underpinning financial markets, suggesting that the risk reward there could be quite attractive.
What about the action for this Sunday, though, Jay? NFL playoffs. Come on. Who have you got?
That's why I love coming on with you, Scott, because you actually do the work, you actually read the musings, and as an author, as the guy who writes it, it's always nice to engage with someone who's read your work, right? So you clearly, and you read all the way to the bottom, which is also really nice. You're not just a headline skimmer. So I do talk about, we've talked about football. It's become something that's really interesting me, how football is changing both on the pro and college level. And on the pro side, I got to think that we're looking at the Ravens and the 49ers winning this weekend, right? The games start on Sunday at 3:00. As I write in the musings, I know where I'm going to be. I'm going to be sitting in front of the TV somewhere. So I expect the Super Bowl to be Ravens, Niners. I think they're the two best teams. And I think the Ravens are going to win. Lamar Jackson, the quarterback, is on a mission to win a Super Bowl, and they've got a team that could do that. And that's my pick, both for this weekend and whenever the Super Bowl is going to be. I think it's going to be the Ravens. How about you?
I think Super Bowl is actually February 8th, I think. Maybe it's February 11th. But I agree with you on those picks. I think I agree with you on those picks. I would love to see Detroit get through because everyone loves an underdog story, right? But I do agree with your picks. But Jay, enjoy the couch this weekend watching the games, and we'll be talking to you again next week.
Yeah, likewise. And I have to say on the Lions, some of the clips on social media of their head coach Dan Campbell, man, they are mighty impressive. You can see why that team has really transformed itself in the last couple of years. I mean, he is really a guy who can motivate. And, just to finish, it's really interesting, right? You have Bill Belichick, arguably the most successful NFL coach of all time, now available to coach somebody other than the Patriots, right? The Patriots and he have parted ways. And yet I think, were 7 teams in the NFL that had a head coach opening. And 5 have now been filled, I believe. And Bill Belichick is still sitting on the outside. And I think there's a reason for that, right? When you, again, go back to Dan Campbell with the Lions, you guys need to be able to relate to the players, right? And they need to be able to work with quarterbacks. And you see, like, as an example, the Chargers got Jim Harbaugh from college, but I think it's Carolina, the Panthers, took a guy who's an offensive wizard, but has 1 year of coordinating experience. So no head coaching experience, and just 1 year as an offensive coordinator because he's done really well with the quarterbacks he's worked with. On the other side, you have Bill Belichick, who's won, 4 or 5 Super Bowls? Oh. And nobody wants him because he's not the type of guy at 70 plus who can relate to the kids today and who is a real offensive minded coach. I just find that really fascinating. The past is not the present, and it's not really the future because things are moving so fast, right? And that quote, just to wrap up, was about college. Because just to finish, and I know you're like, dude, when is this guy going to shut up about sports and football? This is finance. But there's a lot of parallels. And just think about in college, that quote came from somebody talking about Alabama, right? Alabama, kind of like the Patriots, the most successful college football franchise. Coach Saban decides to retire. And within 2 weeks, 25 guys leave Alabama for the college transfer portal. And that tells you right there that the past, all that history, all that success really doesn't mean anything, right? Because everybody left. 25 guys said, I'm out. I'm going to go see what I can do elsewhere. In today's transfer portal and NIL, the past has nothing to do with the present in college football or in the professional game. And Bill Belichick and what's happened to Alabama since Coach Saban left, to me, really reflects that. And I think same in the markets, right? The action in the last couple of years, anybody who was using models going back 10, 20 years, they didn't work because we're in a different environment. And I think being forward thinking, forward looking is where we have to be if we want to be successful in sports and in investing. I'm done.
Maybe Dan Campbell needs to go over China and do an inspirational talk to
yeah, exactly. Well, hey, if you look at how successful China's the #1 market outside the US for the NBA. So I'm sure the NFL is looking at that and saying, we'd like to be there too.
I think it's the same for Premier League as well. All right, listen, let's wrap it up. Enjoy the game on Sunday, Jay, and we'll talk to you again next week.
All right, buddy, you too.
And for everyone else out there, good luck investing.